Okay, so the first thing which I want you to understand is these are accounting and financial reporting standards. These are not funding standards. GASB isn't telling you you have to do this. It's just telling you if you don't do it, you have to show it on your financial statements. So these are financial reporting standards. And they talk about what you should show under pension expenditures, under expenses, pension liabilities, note disclosure, and a lot of RSI. These standards apply not only to general purpose governments, but government-owned colleges and universities. These are all those that are subject to GASB rules. Okay. Now, what happens is when you look at the CAFR report this week, you'll see pension disclosures. But those are the fiduciary fund pension disclosure. The state of New Jersey issues its own pension fund report, which is different from the CAFR. That has a lot more, has actuarial data, has lots of different things. So what we are doing is just concentrating on the employer side itself. These are the statements that are required. Statement of planned net position, how much do you have to pay pension? Any changes? Funding progress, and we'll take a look at each one of these quickly, okay? Now, someone had mentioned, I want you to understand the difference between defined benefit and defined contribution plan. Defined benefit. Notice the word defined benefit. You know what you're going to get. Defined contribution, you're going to put a certain amount of money in. So this is the choice you have when you start working. You can have a little plan of your own where you put a certain amount of salary in and your employer matches it or puts a little bit more. And you are responsible for investing those monies. That's what? A defined contribution plan. And hopefully you do a good job so that in 33 years you'll have enough money to retire on. You take the risk of investment. Defined benefit plan, you don't have to deal with it. It's like a money truck following you when you're at 55. Every month you get a check. So which one would you like? Defined benefit or defined contribution? Do you think you would do better if you invested money yourself? Yeah, what do you think, Aaron?
How does the shortfall get made up?
Well, see now, good question. See, when you work for the government, there is, and this is the law which is being tested in courts right now, you have entered into a contract with the government that by your making the contribution, the government guarantees you that benefit. And if they do not have the money, they have to go out and tax everybody to raise the money to pay your pension. This is the law that's being tested right now. Because it's being tested, actually, if you read about it in Detroit, this is the question that comes up. But defined contribution is a tricky thing because a lot of people have invested, and in the past couple of years they have seen what? Their money just shrink. And this is your retirement money. So what happened in the past was that people worked for the government because, one, they knew they could leave by 5 o'clock. Two, they didn't get paid a lot of money, but you know what? Those retirement benefits and health benefits and vacation days and days off and sick days were great. They loved that. But they didn't get paid that much. So they made that decision. But almost all private sector employers don't offer defined benefit plan. It's too much of a risk for the employer. They're not going to guarantee you that. So it's usually defined contribution plans that are offered. So I want you to understand the difference between these two. defined benefit and defined contribution. And this is one of the, as an accountant, and now since you've taken governmental accounting, somebody might ask you one of the most important questions they're going to ask you is, how does a pension look? And you look at the numbers and you say, even though there are all these calculations, financial calculations, you want to make it very simple. What's my liability in the future in today's dollar, and how much do I have today? If my liability is $100 billion and I have only 50 billion available, what's my funding ratio? 50%. Right? What we have learned is that when you have a funding ratio of 80% or better, you're in okay shape. Though some of you might be surprised, why 80%? Shouldn't it be 90%? Yes, it could be. But usually when it's below 80%, alarms go off, because that means there's something going on. That's the concept of funding ratio. And we'll spend a whole chapter on evaluating the financial health of a government. But that's so the term is actuarial value of assets divided by actuarial value of accrued liabilities. What you have as opposed to what your obligation is. Let's take a look at some other terms. Annual required contribution. Now what happens is that New Jersey would go out and hire an actuary. What's the actuary's job? They look at the entire population of state workers. They look at their salaries. They have a computer model. They look at their ages. They look at all of this stuff, and they say, New Jersey, based on all of this, you should put in $100 million, and the employees should put in, let's make it easy, $100 million. If you do that based on our earning rates, you will have funded your pension obligation this year. That word, annual required contribution, is that number. It's calculated by actuaries. The normal cost is the cost that they come up for each year. That's the cost. They'll give you this cost. This is the number. That's the normal cost. If your plan was funded 100%, your normal cost will equal your ARC, which is your annual required contribution. But the problem is, what do you do with the stuff that's not unfunded? Can you forget about it? No. If you didn't fund this thing, you need to recover that money too. So that's why we say the annual required contribution is the normal cost with the unfunded actual liability, which is amortized. Okay, but these are some technical terms which I want you to be familiar with. Okay, they're not easy terms, but you should try to see if you can understand these. Net pension obligation, as I said, is basically the difference between what you're required to put in and what you put in. If you're required to put in 100 and you put only 50, net pension obligation of 50. Next year you do the same, net pension obligation of 100 million. Annual pension costs. It's your ARC plus interest on the beginning of NPO. Now, I want you to just think about this for a moment. And I know it's getting late, but we'll get through this. It's not too bad, okay? The actuary tells you you're supposed to put $100 million every year. You didn't. Now you have net pension obligation. Not only do you have to meet the net pension obligation, but the interest that you lost on the stuff that you should have invested in. That's that second item, interest on the beginning of NPO. So you're required to put the ARC plus the interest. And then there are adjustments, I won't get into that, but those are minor items. But the big two items are the top two items. Let me just go over one other thing. So your annual pension bill is $100 million. You put in only $50 million, the employer. Let me ask you this question, and you don't know anything about this. What's my annual pension expense for that year? I'm supposed to put in 100 million, I only put 50. What's my pension expense for that year? Pension expense. What does the word expense mean? That's the amount of what? Cost that's expired or consumed. In this case, is it 50 or 100? It's 100 million. Just because I didn't put in 100, so the pension expense is what? 100. What's pension expenditures? Is it 50 or 100? 50, because that's based on modified accrual basis. So pension expenditure can be different from pension expense. So please understand the difference between pension expense and pension expenditure. And basically what this slide talks to you about is that, you know, when you have a government employer, you could have activities between governmental employees, enterprise employees. You're supposed to allocate that among the different business type activities as well as governmental activities. There's one thing that I want you to it's on page 332. This chart, you have to understand this chart. And the terms. Let's start off. See, first of all, see the history? It's not 1 year. What is it? Current year plus the previous 5 years, right? What's the first column? Actual value of assets. Those are the investments. That's what I have. What's my liability? Forget about the entry age. There are different types of methods for calculating actual accrued liability. This is using entry age. But the words are AAL. What's my liability? And take the 2013 number, by the way. You know, it's pretty much the same as the actual value of assets, right? But look at 2008. Actually better, I should have said 2008. What was it in 2008? Actual value of assets were 86. What were my liabilities? Wow. Does that sound good or bad? Well, my liabilities were 80, and what's my assets? 86. So I guess I was doing okay. And what was that by? Approximately 6,000. What was my funded ratio? I have to tell you, this example is not a normal example. It's exactly the reverse when you see the real world. These guys are, are just doing fine, I guess, here. Okay? So, see the calculations. Funded ratio is what? That number divided by the actual accrued liability. And what's covered payroll? That's basically a percentage. 6,000 as a percentage of the 59,584. Tells us what the liability is, or surplus is. It's almost 10% of our payroll right now. Okay. So that's called the schedule of funding progress, and that's required as RSI in the in your report. Yeah, please don't get lost. You'll This is one of the most complicated areas, and I'm just giving you trying to keep it simple here. There are tons of note disclosures that are required.